Good morning, it's Brian. Gonna run through the numbers real quick here and let you guys get on with your day. Gonna try to just stick to the plan, stick to the facts, and we'll leave it at that. So let's go ahead and jump into it. We're gonna run through what's happening in the news first, because we've got some news coming up today that's potentially impactful. We'll have a quick look at forex, although we have some news coming up that's going to impact whether or not we can trade that. So we'll talk about that in a second. Then we'll hit the futures market, and I don't know if I can do crypto. Crypto is still, I don't know. I've got something loaded. Well, let's just go ahead and get to it. All right, so what's happening for the day? Well, we've got some news coming up today. We've talked about this all week. You know, I was first thing this morning. We've got the core retail sales, which is a high impact report, a potentially high impact report, and it's on the USD. During the first 30 minutes of the U.S. trading session, this could send, if it's truly impactful, could have an impact across all currencies. So this report coming up at 7:30 may be a good idea just to stay away from everything until after the report comes out and we have the ability to trade under better conditions, because there's no other news until we really get up here to the 1 o'clock hour. So for forex, in spite of what's happening over here with nice divergence between the pound and the USD, given the fact that we've got US news coming up in 30 minutes, it's probably a better idea just to step back, let the news do its thing, and then at that point, 7:32, 7:35, pop into the market, start having a look at what's going on over here to see which currencies are actually moving that you could potentially pair together. Obviously, as you look at which currencies are moving, you still want to do your check, which we talk about all the time. Just look and see, after that news, directionality, how's it moving, what direction is it moving, do we have range left for that to continue to move? If it's already moved, if the typical movement's 130 pips and it's moved 135 pips, what's the potential for that to continue going? And maybe the potential's there, but really consider that, is there potential for that to continue moving based on what your averages are? And then of course have a look at the volume detail just to see that it supports the direction that you're moving. If you're looking to go long, you'd like to see green over here in the volume detail. If you're looking to go short, you'd want to see red over there in the volume detail, just to ensure that the kind of the buying or selling pressure as orders are coming in support the direction that you're planning to trade. So pretty simple, wait for the news to happen. After the news happens, give it a couple minutes for the market to normalize, then look at your currency strength to see which currencies have the opportunity to pair together, do some just logical checks, and then if there's the opportunity, place your trade. Pretty easy, not a whole lot to it. All right, later in the day, obviously we've got the FOMC report coming out, followed by press conference. So late in the day, which I don't trade this late in the day anyway, but late in the day, if you're trading, especially in the futures market, this could get funky, and it may get funky even leading up to it. Who knows? Maybe totally flat. I mean, like I said before, like I say every day, I don't know. No one knows. Absolutely no one knows. No matter how confident they sound or what channel they're on or what all their email marketing tells you, no one knows. No one truly knows what's going to happen. So we have to have a plan. And what's our plan? Well, we pop over here and we can have a look at what we're doing for the day. Starting off with the S&P, the plan says we want to trade in the direction of the bias, right? And the question always becomes, well, how do you determine bias? We want to trade with the direction of the bias. How do we figure out what that is? There's a million ways to go about that, and you can do it in any way that you feel comfortable with. The way I determine directional bias is I look at moving averages. That's what gives me my directional bias, and I look at that on multiple time frames. So we're just going over here on the S&P. We've got a fast moving average, which is a 20. We've got a slow moving average, which is 100. The 20 is green, the 100 is red. If the green is over the red, we're long. If the red is over the green, we're short bias. That's all there is to it. No consideration to, well, what if the green line turned 45 degrees this direction? Or what if it's 26 degrees and it was blah, blah, blah. I don't care. If the green is below the red, it's short. If the green is above the red, it's long. Period. No, don't make more of it than you need to. That's the thing with trading. We're always wanting to try to make something that there isn't. For some reason, I don't know why that is, but psychologically, we always seem to be trying to make more out of it than it is. Your odds are the same no matter what you do. All we're doing is we're adding filters to the market, things like moving averages, things like watching where your support or resistance zones are. If you use Fibonacci's, if you believe in that, or if you use any other indicator, all you're doing at that point is adding filters to the market to make you feel better about your entry point. And that's all it is. It doesn't give you any additional level of certainty about the market, because what happens from the time you push that button, I'm going to hammer this home. When you push the button, when you say, I have chosen based on the filters that I'm looking at on my screen, and I push the button, your odds are the same as everybody else. They're 50-50. It's either going to go up or it's going to go down, and you can't control that. The moment you touch the button and you make the decision to buy or sell any instrument, whether it's a currency or a cryptocurrency or a futures contract, or you buy or sell a stock, it's going to do one thing or the other. And you can't control it after that moment that you push the button. So the filters that we look at, whether they're moving averages or a combination of 25 different indicators that you want to put on your chart, none of those things give you any more certainty than the other when you push the damn button. I've got to hammer that home, because we traders tend to want to add this and add that and add this to somehow increase their, I think it comes down to level of certainty of what's going to happen next. Now, we can certainly stack the odds in our favor. We stack the odds in our favor by having a plan and by executing that plan consistently, and by having a plan that allows us to, over time, win more than we lose. Not necessarily win more times than we lose, just win more money than we lose. Because that's, at the end of the day, what it's all about. The win rates are relevant if you're losing more money than you're winning when you win. So, if you've got a 70% win rate, but your win is the equivalent of 2 ticks every time you win, but you lose 75 ticks, I don't care that you've got a high win rate, you're going to lose money. So keep it simple. Don't overthink it. Don't make more of it than there needs to be. So I look at very, very simple plans. The plan I have here is crazy simple, but it works. And it works because it is simple and there's not a lot of moving parts to it, and you don't need to overthink it. So anyway, I went down a rabbit hole with that, but it's one of those things that you just, it takes forever. I think a lot of traders run in these circles for a while, trying to add this and 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 get this certainty. Then finally that light bulb pops on and they go, holy crap, I don't need all that bullshit. I just need a simple strategy that I can execute the same way every time to give myself consistency. That's what it's about. Anyway, let's roll back over here. That was a long segue. So 4 hour bias is short. The 4 hour bias is short for me until this green line crosses the red line. For right now, 4 hour bias is short. 30-minute bias, however, is long. We've got a long bias in the 30-minute. The green's above the red. So I've got conflicting bias. My 30-minute conflicts with the 4 hour. So that tells me, hey, the market's kind of in a mixed up little situation here. It's not sure where it really wants to go. One bias is telling me that we're looking to go short. One is telling me that we'd be looking at longs. When that's conflicting, we say, I'm content to sit on the sideline. Let's just move on. We don't need to force a trade. Let's just move on. Okay. Next over, crude. What's going on here? Same thing. 4 hour bias is short. 30-minute bias is long. We've got mixed bias that tells you, hey, sit on the sidelines. You don't have to do anything. No one's forcing you. No one's got a gun to your head saying you have to trade, one time a day, or that you have to take a trade multiple times per day, or anything of that nature. Your job as a trader, no matter what you're looking at or what indicators you're using or anything else, your job as a trader is to find the best opportunity to take a trade. You're looking for the very best opportunity that you can take a trade based on whatever your rules are. And if the opportunity is not there, it's not there. Like I said the other day, it might have been yesterday, we have this mindset of we've got to be physically pushing the button in order to be considered a trader. It's not the case. Your active trading is looking for the best opportunity. If the opportunity doesn't come up, you move on. But you've traded for the day because you've been watching for opportunity, right? That's a really big deal. It's like, liken it to fishing. If you go fishing and you don't catch anything, it doesn't mean you didn't go fishing, right? So let's move back over here. So mixed bias on crude. On gold, we have a long bias. Gold is still in a long bias. It was in a long bias yesterday. It didn't really give us an opportunity to enter during the times that we traded it. It pulled way back and then didn't start pushing back up until later in the day. If you're sitting at your charts all day and you're looking after this pullback, trailing your stop like we talk about, trailing your entry point on the top of previously closed lower highs in a long trend, we'd be looking for lower highs, lower lows, right? You would have had an opportunity down here to maybe trade, but nothing really popped up during my time of day yesterday that I'd be watching. But the trend, the bias is still long. We've got a 4-hour long bias and we've got a 30-minute long bias. So that tells us we're looking for long trading opportunities. So for gold, what are we doing? How are we approaching this? Well, you've got a couple of ways to approach it. One is watching your key level here at the top, which is basically 1980. Now you really get, and again, for key levels, we draw a line because it's easy to draw a line, but just remember it's more of a range than anything. You've kind of got a top of a level and a bottom of a level. So you've got this range for support or resistance. And, it's kind of parked up here at 1980. That's a whole number. It's a big number. But you can even look down here as low. Oops, I didn't mean to move that. I got so used to my TradingView charts that I think I had it right here. Yeah, 1975. But, it could even be down here, around this 1977, and so call it 1977 to 1980 area for your breakout. So if you're looking just as a long breakout, break above 1980, that could be your entry point to go long, which is the direction of the trend. Now, of course, like with anything else, you always have to have a stop loss data prepared to be wrong, how much you're willing to put on the table as risk, so on and so forth, if the trade moves against you, which it very possibly could. We play odds and probabilities, but the directionality, when we look at the bias, we're long. So we'd want to look for long trading opportunities. The other way to look at this would be to look for pullbacks. Pullbacks back down here to 1970, 1960 would be pullback areas to look to buy if it pulls back. Psychologically, easier to trade a breakout than a pullback, because a pullback you're having to buy into the face of a big red candle. That's tough. The other way, and the way that we talk about with the the trading methodology and what we've been recapping when we do the recaps, trade recaps, is we just have a very simple plan that says, hey, if we've got a long bias, we're going to watch for the market to make lower highs and lower lows, and then we'll trail our entry point at the top of that previously closed lower high and put a stop loss at the bottom of that previously closed lower low. So that would require the market to start making, like it did yesterday, start to pull back, and then we would trail our entry point at the top of those previously closed candles, and then wait for market to break back out in the direction of its trend, of its current market bias. Now, if that moving average flips over, then you have conflicting bias and you don't trade. It's pretty darn easy, but that's one way to look at it. Coming back over to S&P and crude real quickly, mixed bias, If you absolutely had to do something, and you know you're just like, man, I can't possibly go a day without trading, in spite of the fact that we've got news coming up and all that. You know, look at your key levels and trade off of those. You know, you've got 19. Wow, where'd that come from? How many years ago did my brain just go back in time to get 19? you've got 34.16 to 34.20 area over here on a 4-hour basis, which is showing, you know, pretty good level of resistance for us. But if it breaks 34.20, you know, you could be watching that level for potential buying opportunities. But you know, it is a short trend. If you're looking to buy in the direction of that 4-hour buy, or looking to trade in the direction of that 4-hour bias, you might continue to be selling off of this key level. Of course, if it pulls down to 3,400, that could be your spot to look for potential buys on a bounce down here. If it breaks below it, then you might be looking at that to start selling, which again is in the direction of that current bias. So just watch your key levels if you absolutely have to do anything. However, do keep in mind, biases are mixed. Think about that. The biases are mixed. Maybe you don't need to do anything, and you've got news coming up at 1, along with a press conference that could throw everything potentially. Could you know? Well, we don't know. It could rally the market, or it could, you know, throw a big wrench in the works, and we could see a down by the elevator situation. Or we can see nothing at all, and the status quo just kind of continues on. No one knows. No matter how confident they sound, no matter what station they're on, no matter who promotes them and backs them and funds them, they don't know. I promise they don't know. For crude, if you absolutely have to do something, you can't possibly sit on your hands when the biases are mixed, then you might be looking for pullbacks. You know, look, maybe trade off this 30-minute if you need to. You know, watch for pullbacks back down to 38.50 and see if you get a bounce off of that. Or if it breaks down below that 38.50, maybe down here to this 38.30, you might look to, especially if it breaks below there, you might look to start selling off oil, which is in the direction of that 4-hour trend. But no matter what it is, I just encourage you to have a plan. You know, have something in place that dictates what you're going to do before the market session begins. So sit down, look at what's happening, make your decisions about how you're going to trade and what you're going to trade and when you're going to trade. And if those conditions are met, trade it. If they're not, don't trade it. I've given you some ideas. We've talked about, you know, the way I look at it with market bias, and then trading in the direction of that bias. We've got some different ways to do that. Today, you know, 2 of the 3 futures contracts that we'd be looking at are mixed. So we're not doing anything. We're only watching 1 right now. So that's it. That's what we do. That's how we do it. And obviously, if there's anything to recap, I'll pull it up and show it to you. We're moving over. I mentioned, you know, I always show my TradeStation charts over here, but I'm going to start moving everything over into TradingView and just keep it all in one spot. What it'll look like is something like this. If you've got a basic version of TradingView, you're not able to show, you know, a 4-chart situation like this. You'd only be able to show 1. You'd have 1 chart open. You know, depending on the level of TradingView that you've got, you know, if you have a paid subscription to I forget what their levels are called, you might be able to do 2 right next to one another and see your market bias, but you don't really need it. You know, if we go to this is the eminis. You know, if you just put a 30-minute chart on there, you know, and load the BTX indicator, you can see your long-term bias and the thick lines, and you can see your short-term bias and the thin lines. So, you know, you can see right here, you've got long-term, the 4-hour bias is short, and the 30-minute bias over here is long. So you can see automatically that you've got, you know, conflicting points of entry. So you can see the bias is mixed, so it tells you automatically don't trade. Plus, if you're using the strategy, it's not going to give you any indicators that anything is even hitting the radar as a potential trading opportunity. It would only give you the red or green arrows if if you've got a situation that is meeting the criteria for the trade. So anyway, that's it. That's all I've got for you for the day. But yeah, you can set that up on your charts. That's the BTX indicator that I've given you guys access to for being here with the channel. In order to get that access, you just got to shoot me an email and I can make it available on your TradingView. I need your TradingView, what do you call it? Username, TradingView username, and I can provide you with access there, and it'll give you those signals that we're talking about now. So that is it. I did say, and I'll reiterate this with the BTX indicator. I'm not going to be talking about that much more here in these sessions, mainly because that's a paid product that I launched with someone, and we're currently working through a whole process to publicize that, market it, so on and so forth. So that paid indicator won't be available for free any longer. I mean, it's something I put out here, and I offered it to you guys for being here and taking part in the channel, but it's not something I can offer for free forever because I've made a commitment to sell that with someone else. And it's an amazing indicator. It does, it's a great way to be consistent with what you're doing. If you just, it alerts you to potential opportunities and allows you to, execute that strategy consistently that we talk about. So I love it. I think it's pretty cool. I am looking at ways to automate that in the crypto markets. So stay tuned for that, because I'm applying a version of that strategy and testing it right now on some shorter time frames around the clock in crypto. So that might be something I can make available to everyone here for free, with some caveats around using certain brokerages and things like that, just so I can obviously get paid on the back end of it. Because again, I mean, the reason we do anything is for potential profit. I trade to make potential profit, and if I'm going to give some stuff away, I'd like to see some benefit from that. Even if it's kind of a not a direct immediate benefit, but at least something to say, hey, people are using this, they're liking it, and I get paid on the back end of it. So yeah, that's something I might offer here in the next few weeks as I kind of hone that in. I'm running tests on it right now just to make sure that it actually does what it says it's going to do, which it is. I'm more concerned, and I always have been in the crypto market, with same thing that used to happen in forex years ago with unregulated brokers. There still seems to be some shady crap that I start to say the words shady crap that goes on with brokers, either throttling inputs during high volatility times, or just overall manipulating the order book. So that scares me a little bit in crypto. I don't think you can ever keep too much money in those exchanges, but it's looking pretty interesting. So I need to see it under some conditions where we see a big sell-off or something, to see if it just craps out on that because it can't get filled. So anyway, that's a whole other story. I guess real quickly, that exists everywhere across all markets too. There's always, there's when we're trading in these markets, we want to always trade during times that we've got the best liquidity for whatever it is that we're trading. If you're trading in forex, you want to trade during times when the instruments that you're trading have high liquidity. If you're trading in futures, you want to trade during times that the instruments that you're trading have high liquidity. Even in crypto, there's times of day when you see more liquidity than others, more orders coming in, more orders being put on, orders being taken off. There's people participating in the markets. Consider that, because that's where you get the best fills at the best prices. For example, in forex, if you're trying to trade, the Aussie yen, that's going to be most active during the Australasian session and maybe into the European session when everything is open. You've got the Aussie markets, you've got the Japanese markets, they're both open, they're both being actively traded. The London market comes online, so now you've got one of the bigger markets in the world that's online and trading, and that's trading at the same time. It's open while the Australia market is still open and the Japanese markets are still open and the London markets are open. They're all trading the pound, they're all trading the Aussie and the yen. Liquidity is high. That's going to be a good time to trade it. 3 o'clock in the afternoon, New York time, is not a great time to trade it. Think about it. The market participants aren't there. Same with looking at indexes real quickly. If you're over on the S&P, you can trade it around the clock electronically. But when do you think it's the most active? You're going to trade it at 2 o'clock in the morning, U.S. Eastern time? You can, but there's not a whole lot of participants. So there's more opportunity to not get the best fill, to maybe not get your order filled because there's just simply no orders at that price you're trying to get in. You might get slipped one direction or the other. You're going to trade that during the most active time, after 9:30 Eastern time when the bell rings and the market actually comes alive. That's when you've got the most activity and the most liquidity, and it gives you the opportunity to get in and get out. Same with crypto, with Bitcoin, with Ethereum. There's times of day it doesn't hardly do anything. There's just nothing there. And you can kind of track that through a volume indicator on there and see when things are going and trade during those times that whatever instrument it is that you're trading is most active. Anyway, covered a lot of stuff today. I think that's it. I'm going to get out of here. Have a great day. Bye.